Hello. In front of me is HDFC Bank Limited's Quarter 1 Fiscal Year 2026 earnings conference call. A lot of important things were said in the mentioned earnings conference call. Here you can see we have highlighted some things in black, and we are going to be reading some of the important things said in this con call. So let's not waste any time, make myself way smaller, and start. So first we move to page 3 of the con call, where a few things has been said by the management. So this has been said by the management. Coming to our performance, let me just recap as to how we transversed this over the last 12-18 months. Last year, we have grown our average deposits at a healthy pace of 16% year on year and continued to gain market share as we have done in the past. Okay. However, we slowed down our average advances or AUM assets under management assets, growth about 7% last year in alignment with our strategic objectives to bring down our credit deposit ratio from 110% at the time of merger to around 95% as we speak today. This rate of growth on the assets under management has improved to 8% in the quarter just ended, which is the June quarter, fiscal year 2026. Our growth engines are well geared to grow as we move forward. We expect our loan growth to continue to improve from here and remain confident of growing our advances at the system growth rate at fiscal year 2026 and higher than the system in fiscal year 2027. Okay, big paragraph. What are they saying? Basically, I believe they are saying that their growth rate in loans has slowed down this year. So last year they did 16% and they were gaining market share. Okay, they had grown the average deposits by 16%, they were gaining market share. Now, their advances or the loans they only grew by 7%. Why? Because they're trying to bring down the credit deposit ratio. So credit, the amount of loans they give out uh, as a numerator divided by the deposits which they have. So credit deposit ratio, this was 110% at the time of merger. So when HDFC Bank recently merged with HDFC, I think the housing company, with its parent company HDFC, its credit deposit ratio was 110%. So the amount of loans it has given out, it had given out as a consolidated figure. So parent company plus HDFC Bank, its credit, its loans were 110% of its deposits. So liquidity was a bit crunched. It was a bit over leveraged, you can say, because a lot of credit, but not enough deposits. So they're trying to bring down their credit deposit ratio. Now it's around 95%. And news, they will try to reduce this even further. Then the rate of growth of assets improved to 8% in quarter one fiscal year 2026. And the growth engines are well geared to grow. So they're expecting the loan growth to improve in fiscal year 2026 and to improve in fiscal year 2027. So they're expecting higher growth rates. Let's move on. All right. The board of HDFC Bank announced an interim dividend of rupees 5 rupees per share. Okay, interim dividend of rupees 5 rupees per share. And they also recommended to shareholders the first ever bonus share issue in the ratio of 1 is to 1. What is a bonus share issue? So if you own one share of HDFC, then the board has recommended that shareholders who own, let's say, one share, you will be awarded another share of HDFC Bank free of cost. But of course, it's free of cost. You won't have to pay anything. Now you will have two shares instead of one, but the overall value of your investment may not really rise because as these new shares, free shares are issued, the value of per share will decline to reflect the increase in total number of issues. So your total value may just remain the same. Okay, moving down, moving down. Now, questions. This next thing is a question asked by an analyst in this conference call. So the question is on growth. Obviously, there is hope that it will recover, but it's only slowing in the interim. So, what will trigger growth from current levels, right? Because in the first quarter, even HDFC Bank's growth was subdued, and so was everyone else's. So, what will trigger growth? Because it has been falling over the last 2 quarters for the sector. So, growth. How will growth return? So, answer. What is the answer? Okay. Second, on the growth you touched upon. So, what is the answer for the growth? This is the answer. First, we have the monetary policy support in terms of rate reduction that puts more money in the hands of certain customers with certain products, and also the yield going down. So, RBI, of course, recently in the past few months had some repo rate cuts. Repo rate cut, so rate reduction in the repo rate will eventually lead to reduction in the rate of loans. So this monetary policy support rate reduction will put more money in the hands of certain customers, and the yield will also go down. The loan yields will go down because, well, the rate of interest has gone down, but more money with people, so they will be able to spend more. This is the monetary policy. The rate reduction will put more money in the hands of certain customers. Then, fiscal policy has also provided relief in terms of some tax benefits. So, people have gotten some tax benefits. Again, they will have more money, so they may just take in more loans, more spending. Then, and the overall, the market inflation, both food inflation and the total inflation, below that 4% target is 3%, and some are even below. The food inflation is extremely low or nothing. All that augurs well for consumption demand to pick up faster, both in the urban segment as well as in the rural segment. The inflation is low, and this is good for the consumption demand. Okay. And with the onset of the festival season, we do expect there will be a greater fillip in that area. Our approach is not only one segment. While we are typically tend to mirror the GDP spectrum, which is consumption being 60%, the retail predominant in that. We are present across all the segments, and we would endeavor for a balanced growth across all with a tilt towards the consumer. All right, so we have festival season coming, we have food inflation going down, and we have some monetary and fiscal policy benefits to the customers. So they're hoping that demand will be boosted by all of this. Continuing all this, okay, some more information on the growth side. So management continues to say, so we are seeing some health, we are seeing some amount of healthy demand from the rural side. I think the segment which we are already catering to is already factoring in better monsoon. And so we are seeing some amount of positive inquiries coming in at the ground level there. So there's an opportunity at that front in terms of potential growth. So they're seeing some forms of demand, better demand, healthy demand from rural areas. Then in the recent past, in the urban consumption, obviously, the premium side, whilst it is growing, there has been a bit of a fatigue, but we expect the festival season, which will start shortly, I mean, whether it is the Onam or the Ganesha Chaturthi, etc., fair amount of festival will start to kick in the country, August onwards or even earlier. I think that mood will have a reasonable amount of impetus, and that could be a good trigger as well. Okay. Urban, they're expecting that though there has been fatigue in recent times, very recent times, festivals. Yes. Moving on. As I mentioned, the fact that interest rates have gone down, the fact that people would now have started to see savings arise out of the large fiscal largesse that was given in the last budget. I think all that will play in with the convergence with the sentiments and the moods which normally the Indian festivals normally bring about. Of the sentiments, sorry, not in the sentiments, of the sentiments. So again, budgets, so savings were there, interest rates have gone down. So loan interest rates have gone down. Maybe people will be encouraged to take out more loans. And the festival seasons are coming up. Nice. Then this was the retail side, the customer side. On the MSME, that is the micro, small, and medium enterprises, I think the sectors that we normally cater to, as I said, despite the kind of uncertainties on the tariff front, I think we have seen a fair amount of upfronting of exports to sort of take advantage of this potential tariff rates. So upfronting, increasing exports to sort of take advantage of this potential tariff rates. And so we do see a reasonable amount of buoyancy in some of the good customers in the MSME segment as well. We should continue even as we get into the second quarter or the second half of the year. Okay, MSME, they seem hopeful. Then, as regarding corporates, big corporates, I think they have been enjoying in the last couple of months reasonably benign interest rates. And obviously, the system says being flush with liquidity, the rates being the rates being offered to those double A and above corporates are pretty attractive. So obviously we may be, to some of the good corporates which you're comfortable with, we shall be participating in some of them for the working demand, capital demand as well. So interest rates have gone down, which will of course mean that the interest rates will be pretty attractive. So maybe corporates will take in more loans. So MSME, they're pretty positive, it seems like. Retail, a lot of reasons were given. So they're expecting, I guess, more positive stuff coming in. And on the corporates, it's not the most like happy stuff, happy tone, but it seems like not bad at all. Nothing bad. I guess they can expect some more upside. And again, working capital loans, they can work with them and all that. All right. Yeah, let's continue. Yes, let's continue. Another question. Now, finally, we're moving to another question, not a growth question. Question is on the credit cost. The credit cost, it has moved up slightly. How does that behave in the next 12 to 24 months? So this, you see this ugly writing? I wrote that. 29 to 41 BP. So credit cost has moved up from 29 basis points to 41 basis points on a net basis. So net credit cost has moved up from 29 basis points to 41 basis points. I think so, yeah. From 0.29 percentage to 0.41 percentage, which is a big thing, credit cost. Now, if you're wondering what credit cost is, if I remember correctly, the numerator is the provisions made for losses, provisions made for bad loans, and the denominator, I have forgotten. The whole, what exactly is it? Um, is it total? It is total income. Credit cost is provisions made upon total income. Maybe you can check that out. Hold up. Credit cost in banking. Okay. Formula. What is the formula? Hold up. We're searching. Credit cost formula. What? Hold up. Uh, okay, no, I was wrong. I was completely wrong. Loan impairment charges upon total loan portfolio. Okay, yes, the denominator is the total loan portfolio, and the numerator is the provisions, the funds set aside to cover bad loans. Yes, not the income. My fault. It is the, what do you say, the total loan portfolio. All right. That is credit costs. The funds set aside for covering bad loans upon the total number of loans. So credit cost has actually come up. So what is the bank has to say about that? Okay, the answer. Credit costs normally in the June and December quarters are slightly elevated because of the agricultural loans, largely driven through the agricultural portfolio. Based on the crop season, it moves up between June and December. I won't venture to give you one particular number, But we have been trying to tell you that over the last few quarters that the credit cost continues to be benign. Benign, not harmful at all. Nothing harmful. And there will be some point in time it will revert to mean. And what is that mean is a moot point, and how long it takes is also a moot point. But as of now, it continues to be benign and healthy. So this uptick in credit costs, they're saying it's kind of seasonal. Okay, this June and December rise in credit costs is because of the agricultural portfolio, which is based on the crop season. So the agricultural portfolio is cyclical based on the crop season, seasonal, and that caused the rise in credit cost. But they're saying again that yeah, it's nothing to be concerned about. That's the main gist. The management is saying that. Again, now next question. The CASA deposits, current account savings account deposits. The bank hasn't really gained CASA market share or maybe even lost some market share in the last 4 to 6 quarters after a stellar 3 year period from 2022 2023. Okay, I think that's 2025, could be 2025. 2022 to 2023, that's 1 year. Okay, so what's really changed? And of course, more importantly, what will reverse the trend? Okay, of course, honest mistake, I guess 2025. Who cares? 2023, okay, 2022, 2023, 2024. That could be 3 years. It has mentioned last 4 to 6 quarters, there hasn't been any gain in the CASA, current account and savings account market share. They maybe even have lost some market share. So what is happening in the current account savings account? This is very important. Okay. So the answer is, if you look at what we needed to do right from the day zero of the merger, we had a massive effort to reduce the credit deposit ratio. We saw this earlier, the credit deposit ratio 110%, currently 95%. So the management is saying the focus currently from day zero of merger is, what you said, decreasing its credit deposit ratio. Let's continue to read. It was a combination of trying to slow down the engine on the loan side and also try and step up the deposits to not only cater to some of the incremental reserve requirements that was necessitated because we took in more liabilities from the erstwhile HDFC Limited balance sheet, but also provide that business as usual incremental reserve requirements as well, where we need to keep that amount of extra deposit momentum. So they're trying to slow down the number of loans they can take while trying to step up, trying to increase the rate of growth of deposits. That's what they're trying to do. Then, why are they trying to do that? Again, they were kind of over leveraged. They need to build up some of these reserve requirements, or they need to build up more reserves, become less leveraged, okay, less loan heavy. So, and mind you, we have had a kind of an environment which is rather challenging, where the liquidity was very tight from the time we merged with HDFC Limited. When you have this scenario, you need to give clear directions in terms of what their priorities are. When you have branches and when you need to give clear directions, the directions that was given was you need to get deposits so you can ultimately ensure that the primary objective of bringing down the credit deposit ratio comes down. So they were in a very kind of a challenging liquidity situation. Liquidity was tight. Liquidity was bit tight. So they told all their branches that the primary objective is getting more deposits to bring down the credit deposit ratio. That is why they could not succeed on the current account savings account, because they did not tell their branches to focus on credit account. See, we did not provide any nuances to say that we want to bring good current account savings account, because you can actually read all this, because to increase current account savings account, you need to do a lot of stuff. You need to sell a lot of other products. So basically, their priority is to get deposits. That is what the signal was given to their branches. And it's reflected in the fact that we got in the deposits and we got in a good amount of market share. So I think one positive we can take is that HDFC Bank focused on more deposits and they got more deposits. So at least they succeeded in their target. That's a good thing. let's just continue. Let's just continue. So again, one thing has come up again. One thing has come up actually twice, that they're trying to reduce the current. They're trying to reduce the credit deposit ratio. Okay. Now this is a commentary by the management. This is an answer, but we're not going to read the question. But let's just see the answer. Some statements by management. First, the dispersal growth. Dispersals or dispersal. Dispersal are the money actually given out as loan. Okay. So dispersal growth in mortgages, if you see, is consciously down. The reason being that there were certain institutions, particularly on the public sector side, which have a rate of anywhere between 7.1, 7.3, or thereabouts. We are not competing right at those kind of rates. And we are more looking at rates which are 50 to 80 basis points more than that to provide better service and get a holistic relationship of the ability to have multiple products. And we're okay to have slower there because that's what we want. The full relationship, not a product, as we are getting pushed at this kind of size. So so the growth in dispersals in mortgages has been down. Growth has been very, very slow. Why? Because public sector, I guess, banks, institutions, they're giving out these loans at 7.1 to 7.3 yield or interest rates, and HDFC Bank doesn't want to compete with them, doesn't want to provide such low interest rates. They want to have like 50 basis points to 80 basis points. So around 7.6, 7.6, potentially 8.1% of yield, I guess they want to provide their loans at. So, okay, I guess they're not sacrificing their yield for growth. They're trying to focus on good growth. Okay, that seems pretty good. And as it relates to non-mortgages, dispersals have been quite strong, and we're seeing that 9% odd growth in the retail assets year on year. And there have been some seasonality every season, and so on and so forth plays out. Overall, there has been some reasonably good there within a growth. At 9.6% rate of growth, there's far higher room to go up to our own standards of where we are used to growing on those books. So 9.6% of growth, I guess, even including the agricultural loans, 9.6%. And but they're saying they have higher room to grow, so they will try to grow even more. And finally, yes, last segment. 22 minutes is pretty long. Last question, last segment. Sashi, this is a question. You said there has been a bit of a breather in the credit deposit ratio in the system and liquidity in response to some of the questions earlier. I just wanted to check from a credit deposit ratio perspective, where would the comfort zone lie? Earlier, I believe it was somewhere between 85 and 90% credit deposit ratio. But now, in the scheme of things, better liquidity, system looking at growth revival, would you be comfortable with a relatively higher credit deposit ratio? If you're asking, is 85 to 90% credit deposit ratio actually necessary? Is what they have now good enough? Now he's saying, see, I'm going to take that Abhishek from a credit deposit ratio. We are at 95, 96. Last quarter was 96. We are currently about 95% in about credit deposit ratio. But quarter to quarter, again, even for this year, it can be different. But in the medium term, would like to envisage to get the credit deposit ratio to be at that level where we are prior to the merger, which is about 87 to 88. Okay, they want to get to 87, 88% credit deposit ratio from 95 of now. So they again are looking to grow deposits more than loans. So that is why between 85 and 90% is a range that is the medium term we aspire to be there. And that naturally comes in when you have deposit growth superior to loan growth and you have been moving on, that will come. And that is how fiscal year 2026 grow in line with the system and fiscal year 2027 grow faster on the loans versus the system gets you in the medium term to around those kinds of levels in the course of time. I don't know what the system means. I'm thinking it means the general banking industry, but not sure. So, so I guess what we can take from this is that in the recent quarters to come, do not expect the loan growth to be extremely high because they're wanting. The target right now is to deleverage. Target right now, exactly deleverage. I don't know. It's a right word, deleverage or not. But what they're trying right now to do is to reduce the credit deposit ratio, is to grow their deposits higher than the loan growth should be. And so in the next few quarters, I guess we should not expect HDFC Banks Limited's loans to grow extremely fast. In fiscal year 2026, they want to grow in line with, I guess, the rest of the bank industry. And then fiscal year 2027, when the credit deposit ratio will reach that 85, 87%, then they will be, the liquidity will be nice, they will be comfortable, and they will try and maybe try to grow faster than the, I guess, the banking industry in fiscal 2027. So fiscal 26, I guess we can see moderate loan growth, and fiscal 27, bank is going to aim at higher loan growth. Berserk.